Phil Orlando is Chief Equity Strategist at Federated Hermes. Phil, welcome. Good to have you with us. I see that the nominal number is supposed to fall to 5.2% from 6%, but as Rick Santelli pointed out, the core inflation number, there's an expectation that it may rise from 5.5 to 5.6. Who knows what it does? Why would there be such a disconnect between what overall inflation and the core, which strips out energy and food? Why would there be such a disconnect?
Well, Tyler, first of all, thank you very much for having me back on. But I think you just answered the question. The composition of nominal and core CPI are just that. They're different. You don't have the volatility of the food and energy prices involved in the nominal number. The Federal Reserve, I think, is looking at all of these metrics. And the thing that really resonates with us is that Powell and this Fed have really been dug in on trying to get the inflation genie back in the bottle. You go back and look at what the Federal Reserve has done over the last 8 rate hiking cycles over the last half century. In every instance, they took the Fed funds rate to a level above the nominal CPI year-on-year number. So you've got the upper band of the Fed funds right now sitting at 5%. As you pointed out, the nominal CPI sitting at 6%. So you look at those two numbers and you say, okay, May 3rd's coming. The market has priced in a 70% chance of another quarter-point rate hike by the Fed. That makes perfect sense. But suppose tomorrow's number falls off a cliff. Suppose that number drops down to 5% or below 5%. Then the Fed's got a little bit of a conundrum. I think the May 3rd meeting, they're probably going to hike again, based upon the dynamic we just laid out, but maybe that's the last.
Yeah, maybe they're done then, particularly in light of some of the reading I've been doing about the way banks are paring back on loans, that they're not making the kinds of and that's tricky because that leads potentially to not just a little blip of a recession, but maybe something deeper, more profound.
Well, you look at where the street is in terms of economic growth right now, their quarterly GDP forecast. The consensus has negative GDP in the second and third quarters. Our forecast here at Federated, we've got negative GDP prints in the third and the fourth quarters. We think this first quarter that is going to be reported in a couple of weeks, is going to be the high water mark for the year. But you're right. How bad or not bad will the tighter lending standards and the banking crisis emanate to over the course of the year in terms of revenues and earnings? To some degree, we're going to be looking towards this first quarter earnings season, which is going to start this Friday, and not just the numbers, but probably the guidance. What are company management seeing in terms of how are they tightening their lending standards? What are their loan loss provisions going to look like? So there's a lot of open questions right now that we'll have better information and better answers to over the course of the next couple of weeks, but we may not have a perfect answer right now, right today.